You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
How did Stacy buy 15 deals in the last 6 years? How did she buy, all her storage facilities? So that's what we're going to go over today. Okay. All right. So funding self-storage. Okay. So when I think of funding self-storage, all right, I think of three different ways for you to three kind of high level ways for you to fund deals. And we all know that you can go to a bank and you can get a loan from a bank to buy property. And typically when people are thinking about investing in self-storage, this is how they're thinking. All right, this is how they're thinking. And I don't know if you guys were on my session last week, but last week, and all these sessions are live, just so you know, there's no recordings, but all these sessions, last week, what we talked about was the 6 different ways to invest in self-storage. And so we can kind of, I'll kind of go through that as we talk about these ways to fund. But so traditional is really going to a bank and getting a loan. Now, the truth is that as you go through the market and the market changes, the lenders, terms and needs and structures also change, right? So, something that a bank was offering a year ago is going to be, when the market was high and interest rates were 3%, is going to be totally different than what a lender is offering now. Obviously, not just in terms of interest rates, but really in terms of just lending capacity, down payments, length of terms. So in the traditional loan, right, when we think of traditional, that's what we're going to think of. And actually in terms of creative and traditional, you kind of think of loans in terms of your payments and stuff. Well, we'll talk about that for a minute. But okay, so when I say traditional, I mean going to a bank and getting a loan. Okay. And then the second thing is creative. And I would say in the self-storage investing world, this is not as prevalent as it is in residential. So I did residential, invested in residential real estate for the first 5-6 years that I was doing investing. And you do a lot more creative deal structures, I think, on the residential side than you do on commercial side. People just really don't tend to think of creative deal structures as ways to buy commercial real estate. At least I don't see it in the commercial real estate world. And that doesn't mean it doesn't happen. All right, because this is how I buy all my deals, is creatively. It does happen, but it's very few and far between. And another thing too about creative deal structure is that when I'm talking to owners, they are not thinking creative deal structures. They are thinking cash or bank financing. And so it is your responsibility as the person offering a creative deal structure to educate the owners on this type of structure and making them more aware that you can do these things. Okay, so you want to really, if you do not understand creative deal structures, you really want to kind of educate yourself on all the different ways that you can do that. I'm going to list the ways out. We're not going to get into the specifics. That's why I'm going to do my boot camp, but kind of list them out so you guys have an idea oh, I really need to learn about this, is what it is. Okay. And then as of last year, so really the year before last year, last year was 2022, I started syndicating deals. But in order to syndicate deals, it takes you a long time to be able to do that. This is not, you can't be like, oh, I'm gonna syndicate a deal tomorrow and then like syndicate this deal, because you have a lot of stuff that you have to do to go through for the process and stuff. So really in 2021, really in 2020, in August of 2020, I decided that I wanted to start syndicating deals, syndicating self-storage. And then I had to educate myself on how to go about that process. So I did that for literally like almost 6 months trying to figure it out. And then after that, I hired like a consultant and attorney to help me start putting PPMs together and stuff like that. So it took a long time for me to figure out the syndications portion of it. All right. But I want you to know that that is available, especially in the commercial side. There is, everybody wants to do syndications, right? So if you want to own more than one storage facility, you have to think about this. In the world of storage investing, there's about, let's say, 55,000 storage facilities in the country. Okay. And so if you're saying 55,000, and there's like, I think there's like 5,000 storage facilities in Texas, and there's another 5,000 storage facilities in California. Okay, so that's like out of 2 states, there's 10,000 storage facilities. Okay, and so then all the other states, right, have 40,000 storage facilities or 45,000 storage facilities. And that means that there is roughly, 1,000 storage facilities in each state. All right, so on average, now there's a little bit more, like Nevada only has 400 storage facilities. There's some that have less than it and some have more, but on average, let's say 1,000, okay, just to make it numbers even. And out of those 1,000, storage facilities, 30% of those are owned by REITs, right? So a REIT would be a REIT is like Public Storage and CubeSmart, Extra Space, all this kind of stuff, right? So 30% gone. So that leaves, let's say, 700 storage facilities that are owned by mom and pops like me. Like I'd be considered like a mom and pop, okay? Now, out of those 700, I would say half of those are one owner owners, like one facility owners. They only have one facility and that is it. Okay, and then maybe half of them have 2 facilities or 3. Very rare have more than like 5 facilities. Okay, very, very rare is this, right? And so just think about that, in terms of how many people out there are actually truly investing in self-storage. Not a lot, all right? Not a lot. I'd say what, 30, 40,000 people out of the whole country? Right? There's not a lot of storage facilities out there. There's just not, and then of course, everybody wants to get in self-storage, right? And I talk to owners all the time, essentially on a weekly basis. I'll talk to an owner that says, look, I get like 1 million calls a week on on buying my storage facilities. But I never really actually get offers. Like I rarely ever get an offer. And in fact, it's the same thing for me too. Like people call our facilities and say, look, I'd be interested in giving you an offer. But then they never pursue it. So you have to distinguish yourself from the people that are actually going to put offers out and do it versus the people that are just here listening. So it's going to be interesting to me to see who here on this list is actually going to put an offer on a storage facility, and very, very few do. Okay. And so, but you have to think of in terms of how you're going to, when you think of all the different strategies of funding, how many of those out of, 20,000 or 30,000 storage facilities in the country are syndicated, have traditional financing, or have creative deal structures. Obviously, creative deal structures very, very minimal, very minimal. In fact, I've never talked to an owner that is actually owner finance. Oh no, sorry, that's one. I talked to one where they were actually seller financing or doing some creative deal structure first, and then I would come in and make the offer. They either own it free and clear, or maybe they have a mortgage on the property. And another thing too is you really have to understand now in primary markets, Most owners are not going to own the facilities outright. They're going to already have mortgages on the property, something on the property, okay? But when you get into like secondary markets, more and more owners own their properties outright, you know, especially if it's a mom and pop. And then also when you get into tertiary markets, like when you're in the country or in you know, in towns and stuff less than 25,000 or less, a lot of those owners own their properties free and clear, or maybe they have a little bit of a mortgage, but they are very, very much open to doing creative deal structures. So for instance, we talked to one in Georgia last week, and I had a Zoom meeting with him, and he owed $225,000 on his storage facility, and he wants to sell that storage facility for $750,000. If we would not have asked him how much money he owed on that, we would never have been able to actually convince him to do some sort of a creative deal structure, right? So you have to make sure when you're talking to owners, you're asking them, how much money do you owe on your mortgage? If it's, you know, if it's an amount of money that you think you can come up with, then you could probably owner finance that deal. I mean, and in fact, the last facility that we closed on, which is in Leesburg, Florida, for $2.4 million, the previous owner owned, it was owner financing the deal from, I mean, the person that we bought it from was owner financing the deal from the previous owner, right? You get that? So the previous owner, the one that we bought it from was actually owner financing the deal from the previous owner. So the previous owner, like the first owner, had the building, and it was just an empty shell building, right? Because we bought a conversion. And then the new owner got the facility, got the building owner financed to them, and then they built out the conversion. And then we bought the conversion from them. Now, when we bought this facility, we also got it owner financed. All right, so think about that, okay? So it's a creative deal structure. So that is the way that we bought that property. It already had a loan on the property to the first owner. So we did an assumption. We assumed the first owner's seller finance deal. Okay, and he owed like, I think, 400 grand. The owner owed 400 grand to the first owner. Okay, and we bought that property for 2.4 million. And then the second owner, we got them to seller finance the deal to us. All right. So just think about that. So now we have two loans on this property. One of them is the assumption, and one of them is the seller finance deal. And so, and then, right? So that is one way. So when you think of creative deal structures, you can assume a loan. Right now, you can assume a loan, whether it's done creatively the way that we did it, or traditionally. So for instance, one of my students assumed the loan from the bank that the bank was, but that the loan was from, right? So I want you to always think about assumptions. As a way for you to purchase a property, if they're open to it. Say, look, I mean, you have a loan on the property. Would you be interested in just letting me assume that loan? And I'll just start making the payments for you. Right now, of course, you have to like look at the terms and stuff like this. Is it a good term? But this is one of the ways for you to buy the property, right? Because the reason why we did this structure is because the owner did not want to pay the loan off and lose that money. Right? So like we owed 400,000 to the first owner, and then we got a loan for like $1.2 million. We had to put some down payment down. And so that 1.2 million, that owner did not want to give that money up. Right? So what we did is we convinced the first owner to allow me to make payments there and to allow me to make payments to the second loan. And the really good thing about that too was I got, for both of these loans, I got interest only payments. Okay. Okay, interest only payments. So I didn't have to worry about amortization. I wanted to have the mortgage as low as it possibly could. And the reason why I wanted to get my mortgage as low as I possibly could in this scenario was because this was a mismanaged property. It was mismanaged. So it wasn't producing the amount of money that it could be producing. Right? So it's supposed to be making $30,000 a month, 30 to 32,000, and it was only making $9,000 a month. So when I hear that and I see that in my numbers, it automatically triggered me to think, okay, how am I going to buy this property? When he wants 2.4 million, it was really only worth about maybe $1.4 million. So I paid $1 million more than what that property was worth. Right? And so a lot of people are like, what the hell? Why would you do that? That's crazy, you know? And that property, once it's making $30,000, $35,000 a month, it's valued at like $4.5 million. It's because that's at $2 a square foot for climate control, right? Because it's all climate control. Plus there's some commercial space and there's like extra ways to make money and stuff, but it's valued minimum $4.5 million. So I'll make $2 million on this property. And guess what? The down payment was $700,000. I had to come up with $700,000. Okay. So what I did was I syndicated that deal. I syndicated it. Okay. So that means I raised the $700,000 to put the down payment, and I didn't put any money into that deal at all. So I essentially got a $2.5 million facility for no money. I assumed the loan. I got it seller financed. I got interest only payments, and I raised the money for $700,000 to purchase it. Okay. And so now we have two notes on this property. We have two notes, an assumption and a seller finance note. All right. So guess what? The owner with the seller finance came to me. I owe him $1.2 million. And it's like 5% interest. It's a good interest rate, honestly. All right. And so we negotiated that. So over the course of, it's a 2-year loan, he gave me 2 years interest only. So I'll have to pay like almost $1.5 million, or maybe, about 1.5, 1.55, something like that. In interest, I'll have to come up with like $250,000 or whatever it is on the loan. Okay. So now the owner has come to me and he told me he will sell this note to me at a discounted rate of 30% off if I can close within the next 9 months. All right. So this price is a 30% discount. So he told me that if I can come up actually with $1 million in 9 months, I will save all the interest plus some. So he is basically selling me his own note at a discounted rate. So I could save $400,000 in the next. And so then on top of that, I said $1 million, I got to come up with that in 9 months. In like 9 months, I was like, oh my gosh. I was like, what if we do quarterly payments? What if I do $350,000 a month every 3 months? Would you work with me on that? He said, yeah, I'll do that. So if I can come up with $350,000 in the next 3 months, then I'll be able, I mean, over the course of the next 9 months, but every 3 months, then I will be able to save $400,000 on this deal because the owner is selling me at a discounted rate. Okay, I don't know how much more creative you can get on a deal. I don't know how much more creative you can get on a deal. But that is an amazing deal. And if I can do that, I'll make a lot of money. Right? But the truth is that in commercial real estate, when you're talking to people, nobody does this. All right. So it is your job to learn how to do this stuff. I'm gonna tell you, because you can get so many awesome deals that way. Does this make sense? Any questions on that? All right. Assuming a loan, seller financing a note, interest only payments, and then buying the note at a discounted rate and separating that into payments. Does that make sense? Any questions on that? Put it into the chat, okay? When I talk about that, my heart is like so full of joy. You have no idea. And guess what? I tried to wholesale this deal. And I showed it to a lot of people and they all passed it up. Just like the 3 facilities that I'm trying to sell now. A lot of people have looked at my 3 facilities and they just pass it up. And nobody has, I got a couple of offers, but like nobody comes up with offers. Nobody comes up with a creative deal structure. Nobody tries. All right. I was just complaining to my husband about that. It's like there's so much opportunity out there if you educate yourself on that. Okay. All right. Another one that I want to talk about is the one that I just closed on. Another one in Tennessee that I closed on. It's the traditional. It's the SBA projected based loan. This also fits with mismanaged facilities. Okay, now obviously, income producing properties, we can go to a bank and we can get a loan. Okay, but most properties are not, they're income producing, but they're not producing what they should be making. Okay, like there's always some upside. Rarely do you ever see a facility that's like actually making what it should be making. That's very, because the truth is that owning a storage facility is like, it's like a roller coaster. It's like, when you manage a business, you've got upside and downside, so like during COVID, it was an upside, right? I mean, everybody was full, paying the highest rates. And it was amazing, 3% interest, right? Well, guess what? Now the shit's about to hit the fan, right? And so now you have the only those that can actually truly manage a property correctly is really going to be able to manage these properties. And another thing too is that everybody's running their numbers at 10% full vacancy and occupancy. And the truth is, It don't matter how beautiful your storage facility is. It don't matter if you got some curb appeal, if you painted it, if it's like all paved, asphalt, brick walls fenced in. This does not matter when you're talking to a lender and trying to sell your property or get a property financed. What matters is this, and that's it. Because I'm seeing that when I talk to lenders. What's your occupancy? What's your vacancy? How much money are you making? I can have the ugliest storage facility in town, but if it's rocking and rolling, making a lot of money, that's what the bank wants. So I really don't understand the concept of having like beautiful facilities. Maybe you could charge a little bit more, but the truth is people can't afford a lot of money right now. I just can't. You got to think about that too. Occupancy. This is the issue and concern over the next couple of years for storage. Not only for storage, but for commercial, real estate, but for storage, right? So there is a fine line between occupancy, vacancy. Occupancy is physical versus economic, right? Economic. Oops, I spelled it wrong. Economic. Okay. Physical versus economic occupancy. Being full doesn't mean that you're making the money that you should be making, right? Okay, so run your numbers and try to figure out what your occupancy should be for that market. A primary market is not going to have 95% physical occupancy, and it ain't definitely going to have economic occupancy, right? So because economic occupancy is how much people are actually paying. And if you're, primary markets have a lot of turnover. And, so because we have our Fairburn location, which is really around, it's about 80% full. And I was talking to the lender and he's like, 80%, that's perfect for that location. I was like, really? He's like, yeah, that's full to us. Primary location, 80% is full. And then we have our next one, which is Noonan, which is about 20 minutes more south of the city. And that one's also about 80% full. And he's like, yeah, that one should be a little bit more full. That should be 85% full. Right. And then we went to 20 minutes more south for our facility. And it is, luckily it's 90% full, but the economic occupancy is not 90%. The economic occupancy was 80%, 79, 80%, because people aren't, to get people to pay and stuff like this, so he was like, you need to bring the numbers up for your economic occupancy. You can't just be physically occupied. You have to also be occupied, right? So that is where I'm telling you, occupancy is the most important part of owning a storage facility. If you do not understand this concept, and if you are not thinking, how can I make sure that I am economically at 85, 90% occupancy all the time for my storage facilities? What is my strategy? Okay, that's what you should be thinking as an owner. But that is where an SBA projected base loan comes in. Okay, so for instance, our Tennessee facility, right? Our Tennessee facility, there's 275 doors. And there was 75, parking. This is for our Tennessee one. Okay. It's like 30,000 square feet or something like this. It's like 350. I mean, it's like 30,000 square feet. So it's a pretty big storage facility, you know, and we picked this one up also for $2.5 million. Same numbers, like almost exactly. It's like the funniest thing, except for this owner, he had owned this property since he built it, which was like years and years and years. And then he's older, he's sick, he's dying, he got COVID. He got COVID back in like 2020 and he never got over it. And he's not doing well. And they don't think he's going to make it in the next, you know, month or so. So they were really pushing to sell the property. All right. We ran the numbers and like, I can't remember what the numbers were, but it came out to like $1.4 million. And then, but they wanted to sell it for $2.4 million. So again, the same concept. They wanted $1 million more for the property. So when somebody wants more money for a property than what the numbers come out to, right? So what people are doing is they're running their numbers and they're saying, okay, Stacy, I put all the numbers into the deal analyzer and your valuation is coming out to X amount of dollars, but this guy wants to sell his property X amount of dollars. So how am I going to get how am I going to make $1 million? You know, how can I do that? Or how can I make $250,000? Like one person just posted into our Facebook group. Make sure everybody's in our Facebook group, right? So just search Super Simple Self-Storage so that you get in the Facebook group. But he posted out a deal that he was working on, and they want $750,000, and he was coming out with like a $500,000, valuation, which is like totally typical, right? Because, you know, especially if you have it on Craigslist and you're listing it and the realtor doesn't know what they're doing, and then they try to list it and they have to make their money as well. So it's like a whole thing, right? But the truth is that if you can either get an SBA projected base loan, right? Or you can do a creative deal structure, still buy this thing. Just as long as you know that maybe your first year, your cash flow is going to be tight or you're going to be coming out of pocket, right? So for instance, on this deal that we bought here with this loan and stuff, like our loan payment, our interest only loan payment was $7,000 a month that we have to pay. And it was only making $9,000 a month. So we know that we may have to come out of pocket for the first couple of months to get the thing up and running, or even longer. And we are okay with that because we know on the upside, on the back end, within 2 to 3 years, we're going to double or triple the value of that property. But the truth is the only way that you can buy these properties is if you understand creative deal structures, you know how to raise money to do deals like this, because you have to either pay cash or you have to do a creative deal structure, or you could do an SBA projected based loan. And the SBA projected based loans, I'm going to tell you, are not easy to get. It's not that it's not easy, but it's a lot of work, as in like it's a lot of work to do what they need. You have to jump through a lot of hoops to convince a lender to lend you on a projected based loan, because they want to see your goals for occupancy. They want to see your goals for price increases and occupancy. We could put this down. I was going to say occupancy, and then we could do price, rates. Price. So when we applied for this SBA projected based loan, we had to show them, we had to give them a business plan. Like we had to make a business plan showing what the property was making now and what it could be making. Right? We had to put this whole thing together. We had to put a financial model together. We had to do so much stuff in order to convince this lender to lend to us $1 million more than what the property was worth. And it took us December to April. So December, January, February, March, April. So four almost 5 months It took us about 4 months, almost 5 months to close that loan, and a lot of hoops and a lot of work to get it closed. But we did it. We only had to put 10% down. A $2.5 million facility, and we only had to come up with a couple $100,000. Okay. So SBA projected base loans are amazing and awesome. And it depends on your experience, how much money you have to put down. 10 to 15% is typical. The interest rates are going to be higher, obviously. So you want to make sure that you're like 50 cents on the dollar for these deals, right? You really need to be 50 cents. So we bought this thing for $2.5 million, and it's going to be valued at $5 million plus. And so once we raise the rates and make sure that the occupancy is at 85 to 90%, that property will be worth over $5 million. Okay. And so we had to convince the bank and the lender to give us that loan. And somehow we did, and they gave us a loan. And so but then guess what? I had to, for this, right? I had to come up with, it was a $2.5 million deal. We had to come up with, let's say 15% down. And also another thing is SBA loans are super expensive. They have so many fees, ridiculous. So you really want to be, for an SBA, you want to be 50 cents on the dollar. Is that 50 cents? 50%. Yeah, 50 cents. So 50% LTV, loan to value. Because you're going to have a higher interest rate. And also, SBA loans are variable, right? So interest rates are really high, they just move according to so you have to make sure and prove to the lenders that you'll be able to afford the interest rate as it goes up or down, right? And so you typically can't afford a high interest rate. The higher the interest rate, then the more of a spread you need on the deal. That's why I say 50 cents LTV, right? But we had a 2.5 million. And then we put I think we had to put 100, I think we put 150K for CapEx. So we told them we had to come up with 500K. But that included the 150K CapEx they wanted to keep, and then we have to do draws and stuff or whatever. So, so we had to come up with 500,000. So this $500,000 for a down payment, you're like, oh my God, now where do I get that, right? Guess what I did? I syndicated the deal and raised the money for the 500,000. And we had I think 10 to 15 lenders, investors putting money and pooling this money together. So syndications essentially allow you to pool money together. So we had X amount of people putting money. We pooled the money together. We raised 900 grand. So we raised way more than what we needed. But we syndicated this out. And when I say syndication, I just mean the government, the SEC, the Securities and Exchange Commission is okay with us pooling a whole bunch of investors' money together, because by law, you cannot do that. You cannot pool money together. Okay. So we syndicated this out and we raised 900K, used 500K, to buy the thing. And then, and guess what? I didn't put a dime of money into any of this deal. Not a dime. Well, actually, no, that's not true. I paid for the syndication, which cost about $10,000. So I paid for that. So that, and then I got reimbursed. As soon as we closed on the deal, I reimbursed myself for that 10K, right? So I syndicated that deal out, and I didn't put a dime of my own money into that deal. Isn't that awesome? So I own another $2.5 million facility, and didn't put any money into buying it at all. Okay, so that's like two ways to syndicate. I mean, 2 ways to buy storage. Too creative, I guess, to be traditional. I mean, you're going to a traditional bank and getting an SBA loan. But it's also super creative in the way that you can do that. And I utilized syndications in order to raise the money. Okay. So a lot of people ask me over and over, they say, Stacy, how do you buy so many storage facilities? I mean, literally in the last year, I bought $10 million worth of storage, and I didn't put a dime of my own money into any of it. I put a little bit of money into the fund because I co-invest with that, but that's it. Right? That is how I do it. That is how I do it. Now, for the boot camp for June 3rd and 4th, I will go into, all of the different ways and like show you step by step how to actually do all this. But I just kind of wanted to give you an idea of what is out there for you and how I do this. And so if you are interested in coming to the boot camp, then make sure that you go to storagenerds.com. Okay. And the great thing about this, a great thing about these creative deal structures that I'm showing you, guess what? The deal analyzer, my deal analyzer runs those scenarios for you. It's very hard to run numbers on creative deal structures, but we came up with a deal analyzer that allows you to do that. You can run fixed interest, you can do private money, you could do owner financing, you can do like all different kinds of scenarios, right? So that is in the deal analyzer. So make sure you check that out as well too. And there's some training videos and stuff on showing you how to do that, okay? Okay, all right, so that's an overview of kind of what's going to go on in the boot camp. All right, so let me see, we got a couple of questions here. What were terms for the syndication participants? Monthly, for how long? Syndication, when you're like, for syndication, it's really just, it's a hold. It's like a 3-year hold or 4 or 5-year hold. When they put the money in, you come up with the terms. Essentially with syndication, you come up with the terms, and then you have to convince your investors to accept your terms. So one of them was a 3-year hold and another one was a 5-year hold. Right. And then your pref, which is your interest rate that you're paying, could be different too. It could be, whatever, 6, 8, 10% interest. So you come up with those terms when you're syndicating those deals out. Okay. And quarterly payments, monthly payments, however you want to do it. All terms are basically, whatever you want to come up with. And then that creates your terms, create your PPM, the private placement memorandum, and that PPM is really what we call your offering. That's the offering that you're making out to everybody about your deal, and you're convincing the investors of your deal. Okay. And then how do you tell if a property is mismanaged? The only way you can tell if a property is mismanaged is if you get the numbers. That's it, and run the deal analysis. Okay, you cannot look at a storage facility and be like, oh, that looks mismanaged, because guess what? We just got a storage facility under contract in Florida over here and in the Panhandle, and it's looking pretty rough, and it's completely full, and it's making very good money. All right, so that's why I said curb appeal. Big, huge buildings, when you see a storage facility that's super beautiful and perfect, guess what? They need to charge a lot of money for their rents in order to pay for all of that, right? And then you have like a regular metal storage facility, and it doesn't cost that much money to like build those or maintain those, So that's kind of how it works. Okay, if you're going to have a big, beautiful storage facility, then make sure your rates can compensate for how much money it's going to cost for you to build or put that together or buy it or whatever it is. Okay, good. Awesome. All right. So I hope that you guys check out stacyrossetti.com. I hope you check out stacyrossetti.com/fund. That's the Self-Storage Fund of America. I'm raising money for like 2 amazing deals, actually 1 amazing deal right now. If you're interested in passively investing, and then look at the course, look at the deal analyzer, come to the free Wednesdays. Okay. Check out storagenerds.com. This triad right here is really going to help. If you're listening to me and saying, yes, this is amazing, I want to do this, I want to learn how to do this, this is what's going to help you. This is like a DIY, right? This is like DIY. And this is like me, this is like coaching. This is me holding your hand and being there and telling you what to do step by step. Okay. All right. Okay. I appreciate you guys hanging in there, and I will see you guys next week. Take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.